Hey, good morning, everyone. I mean, good morning. Really, I don't know. Good evening. Good
Good
evening, everyone.
evening, Professor.
How are you? How are you?
Okay, how are you?
Good, good. Ibani, how are you?
Okay, thank you.
I see five people in the collaborate session, right? I see, but I think, let me just, begin sharing my screen. Um, but I noticed more people right before I came to the collaborate session. I just took a peek at the today's forum, and I have like 12, 11 people at least. It's 12, but one is me, so uh, that means at least 11 people are in the uh, signed into today's forum. But I see only, yeah, slowly. I think I see more people joining, but five so far, and one person left or disconnected. Uh, Tiana has no connection. Uh, well, that's bad. That's regrettable. Hopefully, she will gain connectivity back soon. Yeah, and I'm having so six people in total because Damien is joining. So I believe yeah, we are kind of we're kind of far behind. I mean, uh, this is why I have dual track. This is why I have dual track, and I've been telling you, um, collaborate session is not the main lecture. The main lecture is always the main lecture is delivered through um, the pre-recorded videos, right? So actually, we are in topic two, right? We're already into topic two. It was actually we um, because of the long holiday schedule. Yeah, this is we are meeting in like 2 weeks, and I made although we are meeting in 2 weeks, I made the videos already available um, for um, last Thursday. So these videos, it's been 1 week, so these videos are not available anymore. But so these videos were available. Let's see. Yeah, it was available. It was available on uh, right September 9th, and it was available for 1 week. But since we were uh, and you all know that videos that are already more than 5 days old, right, can be all found on YouTube. I gave you the channel, my channel, and the playlist. And the playlist, of course, this is Finance 300, so CUNY BMCC Finance 300, and you will find all the past videos, right? Bond 6 through Bond 19, and then stock. We already today we have uh, stock valuation part 10 through uh, part 15, right? These are um, so these are like 6 videos, so that's like 3 hours, 3 hours worth, 3 hours length, or 3 hours worth of videos. So videos, worth watching 3 hours. But the ones, past ones, you can always find on my YouTube channel, right? Um, so we are, but collaborate session. I mean, so the main lecture is already into stock valuation, but in the collaborate session is still stuck in the bond. But that's how much time it takes. I mean, we don't. Uh, and my intention of making it a dual track was uh, to make a rich discussion available, because if you're just meeting in person class, if you're meeting in person class, and if you have a physical time limit of 2 hours, 2 hours 30 minutes, 2 hour 45 minutes, then um, uh, there are many things we cannot discuss in depth. um, so uh, that's why the main lecture also gives a lot, uh, because I the contents are really the contents are not something that can be condensed into 2 hour 45 minutes. So usually in one um, for 1 week, for the entire week, I give you like 3 hours worth of videos, right? 3 hours worth of videos. And then so that you can um, take your time watching, or uh, you can replay the videos, over and over until that comes across to you clearly. Now, and then using this collaborate session as like an afterglow, right? So that we can have reflections. So obviously the reflections will um, fall behind the actual uh, uh, progress of the main lecture. Um, but then you are in a way it's a double kill, right? It's a double kill. uh, you should have already learned studied this material through the main lecture videos, and in the collaborate we'll just in a way reflect and review, so this way we can double kill. um, but we are inevitably below the behind. We're inevitably behind the schedule. So I gotta let me get without further ado, let me get started on the. So we were talking in our last class. Uh, we were talking about the horizontal analysis, and horizontal analysis is basically or not horizontal analysis. I'm getting the terminology is being mixed up. It's horizon analysis, time horizon, right? And then horizontal analysis is actually something they use in financial statements, to tell um, actually how much each line items in the balance sheet have grown, or have decreased. Uh, that's horizontal analysis. But the horizon analysis is basically with a time horizon, and if you have uh, what will be the total return by under certain scenario, like interest rate is going to change, and if we know that interest rate is going to change, how much is going to be the holding period return type of thing is. And so today I want to go I want to address, because we're already behind the schedule, because I want to get into a stock valuation before the end of the class today. But if not, at least I want to talk about the strips and tips and credit default swap. And that's because credit default swap is it's a derivative, and it's a but the concept is simple, but that is what caused the main culprit of the the main culprit of the financial crisis is CDI, collateralized debt instrument. But I would say the credit default swap was a complicit. So, if possible, I would like to cover all of that, and bond rating. I don't know if I can do that today, but let's first take a look at strips. Strips is short for separate trading of registered interest and principal of securities. It's a mouthful, but what it means is, of course, it's linked, so you can click on. It just takes you here. I thought it was external link, but what that means is that, for example, if you have $10,000, if you have $10,000. If you invested $10,000 in treasury, right, especially treasury bond, right, and think about it, if this is a 30-year treasury bond, 30-year interest-bearing 30-year treasury bond, and if the coupon interest rate is 10%, that means you're going to receive $100 every year for the next 30 years, right? I mean, from each bond, but you have 10 of them, so the coupon interest that you will receive from each bond will be $1,000, right?
Yes.
10 bonds, right?
Yes.
Okay. Yeah. And someone is with me. So, yeah, Anthony and Ibani, because I thought there is no way, because there is no way I can confirm if people are listening or not. Sometimes I don't want to be preaching to the hollow cave, right? But so now, so you understand the picture, right? You understand the picture. The scenario is, you buy 10 of interest paying coupon treasury bond, 30-year treasury bond. So because the price may be slightly less or more than $10,000, because okay, I hear some background noise, so if you can mute your microphone, I would appreciate it. So $10,000, the face value is $10,000, right? Because the face value is 1,000 each, right? And then they will, if the coupon rate is 10%, they will pay you 10% annually, so $100 per each bond. But you have 10 of them, so $1,000, right? Each every year. But of course, in reality, you understand, that the bonds pay coupons every 6 months, but annually, that's 10%. Every 6 months, it's going to be $50, but annually, it's $100, 10% of 1,000, and you have 10 of them. So you have, you get $1,000 in interest every year. But this is no, so this bond is for 30 years. Maturity is 30 years. For over 30 years, you will be receiving $1,000 every year. Now, if it is $1,000, why not? Why not receive a zero? Why not receive a zero coupon bond with the face value of $1,000? 30 of them. 30 of them. Right? With all different maturity dates. Now, think about it. Does it make sense? If you receive $1,000 interest every year, then you will have to wait until end of this year to receive 1,000, and end of the second year to receive another 1,000. And you have to wait, until the end of year 3, year 4, year 5. You'll have to wait 30, and until you have to wait 30 years until the end of, the maturity, year 30, right, to receive the last $1,000, right? If you're receiving interest in cash, right? Interest in coupon interest in cash. So why not? If it is possible, why not request the Treasury to issue those coupon interest already in bonds, zero coupon bonds, because this is already interest. So the interest won't pay any interest, right? If you receive $1,000 today, you don't. That's just the interest on the original 10,000, and this interest doesn't pay you any interest unless you reinvest this somewhere, right? But the cash interest will have to wait. You will have to wait 1 year, 2 years, 3 years, 4 years. But instead, if they issue discount, zero coupon bonds, right? Zero coupon bonds. They will issue 30 zero coupon bonds, right? 30 with the face value of 1,000. And the first one will mature. They all have different maturity. The first one will mature at the end of this year. Second one will mature at the end of the third year. Third one will mature at the end of the year 3. And of course, the last zero coupon bond will mature 30 years from now. So they all have different maturities, right? Then this can be, so it's just the same thing as the Treasury paying you a 1,000 interest at the end of each year, right? But the only difference is that now it doesn't have to be only you that the Treasury pays the interest to. It can be anybody who is, who has that, zero coupon bond. The idea is now you can sell these zero coupon bonds. In other words, these are the interest to receive, cash interest to receive at the end of year 1, year 2, year 3, at the end of every year, at the end of each year for the next 30 years. And you can't touch it. I mean, if you receive interest in cash, you can't touch it until you receive it. But if you receive all these, zero coupon bonds, 30 zero coupon bonds, you can cash it already in advance, right? Because you can sell them. So think about it. That brings us to this picture, right? To this, graph. What does this graph tell you? If the bond is, if this zero coupon bond will mature 1 year from now, so this is the first coupon, this is the first zero coupon bond, which will mature at the end of this year. You can sell it today for how much? We know exactly what to do. We just discount it, right? We discount it by 10% if it is if the yield to maturity is 10%. And think about it. So we know using the calculator, and it's not a difficult thing. It's $1,000, right? And you divide it by 1.1, and that's going to be 909, right? So $1,000 zero coupon bond that will mature 1 year from now, I can sell it for 909 today. And what about the thing that's going to be what about the zero coupon bond I'm going to receive that will mature in 2 years from now? That's going to be, and it's obvious, 1,000 divided by 1.1 squared, right, raised to 2, right? And it's going to sell for 826.45, 826.45. And what about then? Think about it. What about the one that what about the one that's going to mature in 30 years? The one that's going to mature in 30 years will sell. It will be priced exactly. It will sell at so it's 1.1 raised to 30. Okay, then today it's gonna sell for 57.31, right? Rounded, right? That's exactly what this is, 57.31, right? And then the bond that's gonna mature, right? Zero coupon bond that's gonna mature 29 years from now. And you do that, and it's going to be 63.04. So think about it. This way, if you're a very patient person, and if you think you will live another 30 years, if you think of course, most of you will have no problem living next 30 years, and if you're 60 or above, if you're a senior citizen, like 65 or above, next 30 years is not really guaranteed. So you're impatient. If either you are impatient or you're not likely to live another 30 years, then you can already, cash it today this way, right? Doesn't it make sense? All those interest that you're going to receive for the next 30 years, you can already cash it today, right? This is a wonderful thing. And whoever has bought these zero coupon bonds from you, they will present it to the guy who bought the bond that will mature in 30 years, he paid $57. Of course, he will have to wait 30 years. But the guy who paid $900, $909 today, and 1 year later, he will get $1,000, right, from the Treasury. So this way, the Treasury Department doesn't have to pay interest only to you. I mean, although you are the holder, you are the bond holder of 30-year Treasury bond, coupon paying, right? Interest bearing coupon bond, 30-year coupon bond. Good, that's you. But the coupon interest generated from this 30-year coupon bond doesn't have to be paid to you only, right? Because you have received it in zero coupon bond and you can sell it in the market, and whoever is holding that zero coupon bond will be paid the interest, the par value of 1,000 when it matures, right? Makes sense. So that is that is strips. And the zero coupon bond issued in this case is called OID, original issue discount, right? Of course, it's already, when they are issued to you, because you can sell them in the market at discount. So here's the, then there are two things. Between the 29th of zero coupon and the 30th zero coupon, the difference is $5.73, and this is considered interest income, right? This is considered interest income. And of course, and what am I trying to say? And then, what if there is an interest rate change? What if there is an interest change? Again, when I say interest rate change, right? That doesn't mean the coupon rate. Coupon is always, coupon on the original 30-year coupon paying interest-bearing Treasury. The coupon rate is always 10%, right? But what if the discount rate changes? In other words, prevailing market rate changes over time. Of course, 30 years is a long time, and interest rates, there will be interest rate movements over 30 years. And then, so originally you were discounting it by 10%, but let's say interest rate change dropped to 9.9%. Suppose interest rate dropped to 9.9%. So when the discount rate goes down, right, the whole fraction goes up. So obviously, the valuation gets bigger. And then, so this one, the 29th, the bond that will mature in the 29th year, if sold, under new interest rate, right? Originally, we assumed 10%, discount rate, but due to interest rate change, now we are over 1 year period, interest rate has changed. So now we calculate, we use 9.9% as the discount rate, and then the present value of the 29th coupon, 29th coupon will 29th, OID will go up to 64.72. And then this difference, right? The difference is, like barely $1.68. This is considered capital gains. This is considered capital gains, right? So then,
Professor,
yeah,
I have a question for you.
yeah.
Are we gonna touch base on stocks at one point in the class? Or are we
I
just gonna
said
talk
I will
about bonds
try.
all semester? Just asking.
I said I will try. At the beginning, I already told you. We're gonna, because
Yeah, cause
the main lecture.
I'm really interested in that topic. So, but I
Yeah,
appreciate
sure.
it. Thank you.
Yeah, sure. We're already into the stock by main lecture, and this is only collaborate session is the reflection, so it takes more time. So I said at the beginning that I will try to talk about only three things in the bond, because it will drag on too much if I talk about everything. If I go over everything, it will drag too much, and already everything was delivered through the main lecture. So I'm gonna only touch on the few points. One is strips, the other one is the second one is tips, and the third one is credit default swap. Okay, so hopefully, then by the end, by the second half of this class, a second half, or the last 1/3 of this class, we'll be able to get into stocks. Okay, so that's my
Sounds good. Sounds very
okay,
good.
that's my projection. All right, so tax implication, right? Because IRS imputes, tax on interest income and capital gains. So this is something, we have to be, we have to look out for. This, um, uh, in, as far as the strips is concerned. And so next, I want to, and tips was already introduced at the earlier part, but I think it's worth mentioning because the question, we understand what tips is, because it was also addressed in Finance 100, and it stands for Treasury Inflation Protected Securities. So tips. And it's also called indexed bond, indexed because it's indexed to CPI, indexed to inflation. So the point is, uh, TIPS makes adjustment to the par value every year by CPI, so that if the par value is adjusted by CPI, then coupon interest will also be adjusted, right? So I believe I have an example in here. Where is CPI? Where is tips? I think. Maybe I don't have. Not in this file, but there's some other file that has tips example. But as long as you understand the concept, it's only making adjustment by CPI, making adjustment to the par value by CPI, so it's not a difficult thing. So take a look at this example. Inflation at the end of year 1, year 2, year 3. So this is a 3-year bond, 3-year bond is called, a treasury note, right? Treasury, if the maturity is between 1 and 10 years, it's treasury note. So 3-year, and that means 2%. Inflation was 2% in year 1. In other words, between time 0 and time 1, inflation was 2%. Between time 1 and time 2, in the second year, inflation was 3%, and in the third year, inflation was 1%. So then par value will be adjusted. Because inflation was 2%, par value will reflect it. So par value will be 1,020. And if the coupon rate was 8%, annually 8%, but semi-annually 4%. So 4% of this, right, will be 480, right? And it's 8%. Why is it just 480? Actually, there should be 2 coupons, not just 1 coupon, right? 2 coupons if the coupon rate is 8%. If the coupon rate is 4%, then annually this makes sense. But so I think the coupon rate was 4%, not 8%, because semi-annually it's $40.80, but annually it should be twice that. But anyway, the point is, at the end of all these coupon payments are adjusted by inflation. So it's not difficult to understand. At the end, at the end of year 3, look, the face value was adjusted by all 3 inflation. So in other words, what that means is think about it. It's 1,000 times 1.03 times 1.02 times 1.1. No, this is not exactly right. 03, I'm sorry. I made 1.03, 1.02. Let's try again. 1,000 times 1.03 times 1.02 times 1.01. Okay, now you see disinflation going on here. Disinflation. Yeah, there is inflation, but the inflation is abating. So you see disinflation going on, and then hit enter. Yeah, 1,061, right? 1,061, and that's exactly what you see here. The principal gets adjusted for inflation. Coupons got adjusted for inflation, and so next question is then so the index bonds are only TIPS is the only indexed bond. No, but most likely TIPS only. I haven't checked. Do corporate is there any corporate bond that is indexed? Yes, there may be. I mean, there's no reason there shouldn't be, because but I haven't checked, but it is quite obvious why Treasury has only indexed bonds. I mean, I shouldn't say only, but Treasury is mainly the one that has indexed bond. Why? Because Treasury return is much lower than the corporate bond returns, right? Treasury yield is much lower than corporate bond yields. corporate bonds are generally paying higher than Treasury, but if the corporate bond has like if the corporate bond is like AAA plus. I mean, AAA can each credit rating can be again divided into three different categories. Even in AAA, there is AAA plus, just regular AAA, AAA minus, and AA also AA plus. So if the corporate bond is like AAA plus, that's very safe, very risk unrisky, or least risky. So they don't have to pay high interest. So they may be able to pay just about slightly above Treasury. But if that is the case, the corporate bond may have indexed, inflation indexed bonds. Why? Think about it. Since Treasury pays very low return, if the return on the Treasury may not even be enough to cover the inflation. Inflation is at least somewhere around 2%, and if the Treasury return is below 2%, I mean, it doesn't make any sense to put any money in the Treasury, right? So to compensate for that, they had to come up with tips. They had to come up with inflation adjusted or inflation protected securities, right? So that's why it is more a pronounced feature in the Treasury. Not all the Treasuries are tips. There are specially designated category called tips. Okay, so that's tips. And since I mentioned bond rating, we all understand there are three bond rating agencies, right? One is Moody, the other one is Standard and Poor's, and the other one is IBC Fitch, or Fitch IBC. Although they use a slightly different designation, but it pretty much means the same thing. They have AAA, AA, single A, triple B, double B, single B, and triple C, and so on. Moody's, it's AAA. They may call it A3, A2, A, right? B3, right? B2, B, B1, or but they're pretty much and if I remember correctly, Standard and Poor's are U.S. agencies. Standard and Poor, Moody's are U.S. agencies. IBC and Fitch is a UK agency, I believe.
They're a rating agency, right?
They are rating agencies, and the interesting thing is, back in 2008, the financial crisis. During the financial crisis, I mean, though these rating agencies were not fully, free from blame, because they, think about it, all those CDIs, right? Collateralized debt instruments.
They were mislabeled, right?
Right. Those CDIs were basically bundled. It was sliced and sliced and diced and bundled up. So very poor, very poor mortgage, very poor securities were bundled up with high quality, low quality
mortgage default swaps.
No, that will come into play, right? The mortgage-backed securities, right? Mortgage-backed securities are generally safe. Think about it. Um, but then CDIs become unsafe because mortgage-backed mortgage-backed securities are basically backed by mortgage, right? But of course, it cannot be 100% safe because when there's a default, a lot of a huge massive scale default in the um, housing market, right? Uh, all all of those, let's say normally, there are foreclosures are, let's say only one or two during a regular month, and these foreclosed homes or repossessed properties can be resold in the market at close to its principal value, right? Suppose you bought a house, you borrowed money, $1 million, and bought a $1 million home. Of course, you must make a down payment. Otherwise, there is no stake. If a house is a $1 million, you cannot borrow $1 million and buy a house. Why? Because then uh, there is none of that is your stake, right? You have no stake in the house. I mean, if the house is $1 million and if the bank is lending you $1 million, why would they lend you $1 million and let you live in it? The bank will just buy the house outright and rent it out to you, rather, right? So um, uh, you cannot get a $1 million loan to buy a $1 million house, right? Theoretically, you have to have your stake in it. So that's why your down payment comes into play. Um, but just for our thought experiment, or it's just for thought experiment. Let's say it was possible to get $1 million loan and buy a $1 million house, and this house becomes automatically a collateral, right? The house becomes a collateral. You don't have title to the house. The title to the house is with the bank until you pay off the mortgage, right? So, but in the early 2000s, subprime mortgage was quite rampant. Meaning people who didn't um, qualify for mortgage still got the mortgage regardless of the down payment. But of course, they had to pay flexible rate, adjustable rate. So adjustable rate was low in early 2000s, where when the interest rate was generally low, so there was no problem. But then 2007, 2006 through 2007, the interest rate went up, soared like by 5% from where it was benchmark rate. Fed funds rate was around 1.25, and then just over 1 year period, it went up to like 5.25. So the people in the subprime category who was able to get the loan at like let's say 7.25, for them suddenly the rate went up to like 12.5 or 12.0. Then this became unmanageable. They couldn't, they defaulted. They couldn't pay, and then there was a massive sellouts. Because there was a massive repossession and foreclosure of the properties. So then when if there are one or two repossessed homes during regular month, then they can resell at the principal value. And if that means $1 million they can recover, the bank can recover $1 million by reselling the home, and these $1 million will be paid back to the this $1 million originally came from someone, isn't that right? Because uh, uh, bank loan is coming from um, uh, a depositor, right? Bank loan is coming from a depositor. But when there was a massive sell-off, right? The price of these homes will, let's say they all drop 50%. Then $1 million house, if you sell it, you can only recover of 50%, 500K. Now the bank is in trouble. Bank has made 10 loans, that's $10 million, and 10 loans for $1 million, 10 of them $1 million homes, that's $10 million, and all of these $10 million homes are in the market now, repossessed and in the market. Prices fall drastically by 50%, right? Then all they can recover, the bank, all that the bank can recover is only 50% of that 10 million, so 5 million. Now, how can this bank pay back the depositor or the lender, right? The original, because if I'm the original depositor, and if I deposited 10 million, or there are 10 people like me who deposited $1 million each, either way, the bank owes the depositors 10 million, but they cannot come up with 10 million because all these collaterals are now only worth 50%. So this is called toxic asset, because these assets are now cannot be if you sell, you realize 50% loss. So the thing is, if they made a loan, if they made a mortgage loan, backed by the collateral, they should stop there. They shouldn't do anything. They should just hold. But then what the banks did was, using this collateral as the backup, right, as the underlying asset, they sold securities, which is called mortgage-backed securities, right? So that way, think about it. Bank made $10 million loan. Remember, bank made, because there were 10 home buyers, subprime home buyers. They all wanted $1 million loan. So the bank made $10 million loan. Then the bank doesn't have $10 million, right? Because they made a loan. Bank is short by $10 million, and that should be, it should remain there. It should remain there. The bank should remain there. They shouldn't do any more. They should, by making the loan, and the loan is secured by the collaterals, then they shouldn't do any more. But then what they did was they sold mortgage-backed securities. So they sold to the investors, and then they have, the reason for that is they have $10 million back. They are not $10 million short. They have $10 million again. And with this $10 million, then they can lend again. So this was what the banks did. And then these mortgage-backed securities, and think about it. These mortgage-backed securities will have, some of them will be AAA. I mean, some home buyers have, very high credit rating. Some home buyers have, very poor credit rating. It's all different. Their credit ratings are all different. But then they, sliced and diced all of them into a bundle, so that the bundle became all very opaque. You understand? It became very opaque, because in the bundle there are some that has very high quality mortgage, right? High quality mortgage, and some are very mediocre mortgage, and they are all bundled up. So it became very unclear whether it is AAA or at least there is a way. If we can, it's weighted average. And mathematically, with using weighted average, you could come to some rating. But then this bundle is called CDI, collateralized debt instrument, and then they sold this again, right? First of all, from this point, CDI, that's very risky because it's very opaque, right? But then how do they? If it is opaque, from the investor's perspective, you won't be tempted to invest in it. But then credit default swap came around. What's credit default swap? It's like an insurance policy. So so let's say I am J.P. Morgan or Goldman Sachs. So I make this CDI. I cut up all these mortgage-backed securities and bundle them up, right? And trying to sell this CDI, but the CDI is opaque in risk rating. So they came up with the idea of a credit default swap. What is credit default swap? So I will sell this, but I insure it with AIG.
Financial derivative?
Huh? Yeah, it's a derivative. This CDI is already a derivative, and credit default swap is a derivative. Okay? Traditionally, traditional cases of derivatives are futures and options, but other than futures and options didn't cause financial crisis. It's the CDI and the credit default swap that caused the financial crisis. Okay, so the CDIs, where was I? A credit default swap is so J.P. Morgan and Goldman Sachs insure these CDIs with AIG, which is an insurance company. By paying like insurance premium like 1%, let's say whatever is the insurance premium, let's say 1% on CDI value, and insurance companies like AIG shouldn't have accepted this, but they were their take on the CDIs were okay. Because it's a bundle of there are good mortgages there are in them, and but before all of that, think about it. If the CDI is worth $10 million and you're paying 1% insurance premium, right? That's like $100,000, isn't it right? 1% in insurance. And insurance companies got well, we are 1%. What are the chances of I mean, one or two? There may be one or two that will default. They never thought there would be a massive default, right? They thought if there is one or two default, we can handle it. That's insurance basically. Think about it. Insurance companies, do they face car accidents every day? Every day, but do you run into car accidents every day? I mean, if you have a car, you have car insurance. But how often do you use car insurance, your auto insurance? It will be like a once in a lifetime event. Like if your car gets totaled, if such a serious accident, if your car gets totaled, then you would use insurance. I mean, for minor fender bender, you don't use insurance. Minor, scratch and scuffs, you don't use insurance because you don't want the insurance premium to go up, right? So insurance companies generally have cash flow coming in, but hardly any cash flow going out on a massive scale. So they are used to that kind of mentality. I think that's one of the reasons, why they took on the credit default swap. But by insuring AIG insuring, these, CDIs through credit default swaps, they were able to uh, make, like 1% insurance premium, right? For CD, so if it is, $10 million CDI, or the size of the CDI, or I mean, if Goldman Sachs is selling, CDIs in the total of, $1 billion, right? 1% of 1 billion is what? 1% of 1 billion is 10 million, isn't that right? 10% is 100 million. 1% is uh, 10 million. So think about it. Insurance companies, there is no reason they wouldn't take on this, right? But then, they never expected there would be a massive, default, right? If the default, just like car accidents, I mean, in your life, you will at most use, your car insurance, once or twice, because, if you get into such a serious, devastating accident, your car gets totaled and you're injured, seriously injured. Um, that kind of accident doesn't happen every day. If that happens with you every day, they won't insure you, right? If you're a very unlucky person, though the most ill-fated person in the world, and accidents are plaguing you every day, then nobody will insure you. But the chances of you, and if this, think about it. So accidents happen every day, but insurance. It's not like everybody is getting into an accident. It's just uh, out of the out of 100 people insured with car auto insurance, maybe it's one or two a day. So insurance companies can handle that because the insurance premiums that come in, they have huge cash inflow, but cash outflow will be very small compared to that. And but if everyone gets into accident, every day or every week, serious car accident, your car gets totaled almost, every week. You get a new car, then gets totaled. You get a new car, it gets totaled every week. Then this happens on a massive scale. Insurance companies will go bankrupt. So that's what happened with AIG. So they got bailed out. First, it was Lehman Brothers, which was not insurance; it was investment bank. They got they had massive default. CDIs went bad, um, uh, and they got bailed out. Then Bear Stearns. Bear Stearns didn't get bailed out. They let Bear Stearns go down, and then AIG.
Why?
Well, it was like I don't know. I think they were citing moral hazard as the reason. First of all, Lehman Brothers. Um, First, this was the first occurrence. So they they thought if they let Lehman Brothers go down, the ripple effect throughout the economy, the adverse impact will be too much. Uh, so Lehman, they bailed out Lehman, but then Bear Stearns. Now they thought this will set a bad precedence because due to they will all think that we are too big to fail, uh, because they will, if we fail, then the economy will, uh, devastating effect to the economy will be huge, so they won't let us fail. I mean, this is so they will become uh, that's a moral hazard. So they just think about it. All those asset management hedge funds, asset management firms, they are not taking any responsibility, right? If they make they use your money. They use basically other people's money, investors' money, and then they, if they make big profit, the return is huge. They take big cut, right? They take big cut through fees and through fees, and if they bungle up, if they don't take any responsibility. They will say, investing, we have already informed you, you are doing this at your own risk, blah, blah, blah. So nobody gets any pay cut, or nobody gets, fired. But, the damage is all to the investors. Of course, that's what investing is. When you, if you think, you can take that, then you shouldn't, put your money with the those Merrill Lynch or Goldman Sachs, but they are really taking advantage of you, right? When they bungle up, they don't get fired, or they don't pay you anything. They just still take fee, whether you make positive return or negative return. They still take fee. So that's why you are studying finance, so that you don't have to use any portfolio manager. You become your
Buy
own portfolio
ETFs.
manager. Huh?
Buy
What?
ETFs.
What do you mean? What is IETS?
ETFs. ETFs.
Oh, ETF. Yeah, buy
Yes.
ETF, of course. Buy ETF. Um, Either way, I mean, whether you invest in ETF or in stocks, that's why you uh, that's why you um, study finance, to become your own security analyst and to become your asset manager, right? Of course, ETF, but the idea is, ETF is still managed by, but you can easily, buy and sell. It's still managed by some asset manager, but you can buy and sell. So, and they are also competitive. It's open and competitive, right? So it's not a closed, system. You can track their record, and if they are making, if they are performing poorly, then you don't have to buy them, right? Just like stuff. So anyway, so that was why. Moral hazard. So they let Bear Stearns go down, but then they saw the adverse impact to the economy was so significant. Then the AIG came up. They couldn't let it go down. Then it will deeply devastate the economy. So well, it's really I would say Bear Stearns was very uh, unfortunate. Bear Stearns was very unfortunate. Lehman wasn't bailed out. I mean, I just said bailed out, but Lehman wasn't bailed out. It was acquired by Bank of America, right? Lehman was acquired by Bank of America for a very low stock value. I mean, like, I don't know, 20 cents on a dollar or something like that, right? So that was, I said, this way I bundled up everything with together, bundled up, the credit rating. So in the yeah, one more thing. So when they bought all these CDIs, when they are insured by credit default swap, so that's CDS, credit default swap, they were rated AAA. Right? You understand? Those OPEC um, CDIs all got rated, AAA because of credit default swap. Because the reasoning behind it is, if they default, this is insured by AIG, so they will get, there's no risk. right? Very low risk. So they got all, rated AAA. This is this is a crazy thing. Um, so this
That's it.
graph, yeah, you were asking someone asking something.
So yeah, so by doing the credit default swap, they made it seem like they didn't have debt. So is that how they were able to get like high ratings?
Yeah. I didn't quite hear your question in the middle. But point is the credit default swap basically gave the insurance, right? It's because it's an insurance. It gave the assurance to the investors that in case this CDI defaults, then the insurance company like AIG, because this is this is insured with CD credit default swap, AIG can they will pay you. So that makes it look like as if it is default risk free, right? Make sense? So that's why they
Yes,
got
that's what I was
AAA
saying.
rating.
Like that they made it seem like that way, and then they
Yeah, they
got
just made it
higher
seem like
ratings.
that way.
Yeah.
Yeah, and
Okay.
again, the point is, if defaults happen like like one or two, by fewer and far between. Like you don't have car accidents every week, right? And not everyone has car accidents, every week. Um, uh, if it happens like one or two of these defaults happen, then yeah, AIG can all pay them up, or they can all pay out to all of these uh, CDI holders. But then this happened on a massive scale. That's the problem. Like massive defaults of the subprime mortgage holders, right? This happened on a massive scale, and then they run out of the money. Insurance companies will run out of money, right? Insurance companies will go bankrupt if accidents happen every day to everyone. You understand, right? If it happens, on a massive scale, then there is no insurance company that won't go bankrupt. But this happened, like in a perfect storm, like in the perfect storm condition. There was a massive default, and then the last graph, what they did, this was, so here. Buy credit default swap on Lehman bond in January 2007 and sell in 2008. If you did, and that was right before financial crisis. If you bought credit default swap, right? If you had bought credit default swap at this point and sold before the full blown financial crisis, then you would have made 5% return. And the 5% return may seem like a um, so credit default swap is like paying. Let's say you have to pay to buy credit default swap. You have to pay like 1% on the underlying asset value, like CDI value, 1%, right? But then by then, and then if you sold it right before the financial crisis, then you would have realized 5% return. Um, so then that would be like let's say 4%, then because you had to pay 1%. I don't know if this means even after the net, right, after subtracting 1%, if you so then it must be credit default swap was giving you like 6% return, and then subtracting 1% for paying for that CDS, then you would realize 5% return. 5% doesn't seem like a big number, but let's say this was like $10 million. 5% of $10 million, right, would be $500,000, right? Or if it is, $1 billion, 5% of that will be $50 million, right? Anyway, that's what. All righty. So that wraps up everything. Yield curve. This is an important thing too. But we also talked about yield curve in Finance 100. So I'm not going to go over that again. Everything is well explained in the main lecture video. So this will wrap up everything about bond. Okay. So we'll take a 10-minute break. It's 7:20. We'll take a 10-minute break and reconvene at 7:30, and we'll get started on the equity valuation. Okay. All right. Okay, we're back. We're back. So now we can get started on the stock valuation. Of course, the main lecture has already, addressed all of this, but the when we say stock price, and first of all, we need to define. We need to distinguish between price and value. Okay, price and value. First of all, price and value are not the same thing. You have to make a clear distinction between the two, because we can say price of Bitcoin is like $40,000, but that's value of the Bitcoin is actually zero. There is no intrinsic value to Bitcoin, right? All cryptocurrencies basically, they have price, but the intrinsic value is close to zero, right? It's just like a 17th century Dutch tulip frenzy. And in 17th century, there was a huge speculative bubble in tulip. At least tulip bulbs have intrinsic value. Tulip bulbs have at least I don't know how much it can give you like visual. I mean, if you plant tulips and if they bloom, it gives you at least a visual pleasure or aesthetic pleasure, right? And it has something, at least physical, right? It has something physical to that. You can touch the tulip bulb and tulip flower. You can touch it, smell it, and see it. And so the intrinsic value of tulip bulb is probably, I don't know. I mean, how much they are selling for, I don't know, maybe a few cents. But when in 17th century in Amsterdam, the there was a huge, speculation on tulip bulbs, and they were soaring like crazy, And then one day the bubble bursted. It's just nothing, and all of that. So the price is the result of demand and supply, and if the demand is exceeding supply by huge quantity, then there will be a bubble in price, right? And the intrinsic value value refers to the intrinsic value, and the value is intrinsic value is the rational fair value. So for example, in case of bond, this is quite clear what intrinsic value is. We all know from bond, we know what intrinsic value is. Basically, it's the rational price of the bond is reflecting its intrinsic value, which is all the present value of all the discounted cash flow from the future. And in case of bond, it is quite obvious because we know the coupon rate, so we know the coupon to receive in the future, and we can exactly discount. We know the par value at maturity, so we can exactly discount it to present. So in case of bond, the market price won't deviate that much from the intrinsic value, right? But in case of stock, calculating intrinsic value depends on a couple of multiple things. First of all, whether it pays dividend or not, right? And what's the discount rate, and whether it's growing at a constant rate or at different rates through multiple stages, or whether it is not growing, dividend is not growing or not. But besides all of that, first of all, there is book value and market value, book value versus market value. And what is the book value? Book value is the value of the paid-in capital, right?
Isn't it the market cap of a company?
What?
Isn't it like
Say
the
that again?
intrinsic? Isn't it like the intrinsic value of the company, like the actual value? Like
Yeah,
like
but what is the
if you
value?
account for
What
all
is
the
the value?
assets, if you account for all the assets.
Yeah. But look, what is the value of the company? Look, value of the company is the total asset value, right? But we are talking about the we're talking about the equity. Okay, we're talking about the equity. So total asset value is the book value of the total assets. I mean, you have record in the balance sheet. You have already recorded the book value. You have recorded all the acquisition cost of acquisition of all assets, right? So total asset value must equal to total debt plus equity, right? So and debt and equity are the source of the capital. And if the company's total assets are $10 million, that means the company is raised $10 million through debt and equity in some proportion, like 40% debt, 60% equity, or whatever, right? Or 30% debt, 70% equity. So if total of the liabilities and equity side must balance out with the asset side. That goes without saying. But then what? And on balance sheet, especially the if you're talking about depreciation is the line item that affects the fixed assets, right? In other words, the plant and equipment, physical assets, right? Physical assets, or also called physical assets, real assets, and non-current assets, right? So the fixed assets are basically the plant and equipment and land and building, right? Plant and equipment, land and building. Now, plant and equipment and building, they all depreciate because with wear and tear, they lose value. That's the depreciation. Of course, in accounting, book value is defined as cost of acquisition, purchase cost minus accumulated depreciation. True, but that applies to the only the fixed assets, right? Liquid assets generally don't have depreciation. Think about it. Current assets don't have depreciation. Okay, because there's no wear and tear in current assets. So although this is just the definition by the accounting, when we say book value, and put it into this context, not just what is in the textbook or what they are saying in accounting context, but we are talking about equity, right? So then the book value means the book value of the equity, right? Book value means book value of the equity. And then, of course, the equity could have been used. I mean, as I said, if we assume, let me use whiteboard. Okay, and then let me create another. Smaller, get it? Oh. All right, I'm not gonna use this. Let me use, what am I gonna use? I'm gonna have to, okay, let's try this. Okay, I'll just, so we all understand in balance sheet we have current assets, right? And current assets will break down into cash equivalents, and promissory notes and things like that, and then current assets. Which are basically plant and equipment, land and building, right? Plant and equipment. Plant and equipment, land and building. And there will be, depreciation. You see, depreciation happens only with the physical assets, right? Non-current or physical fixed real assets. Current assets are mostly liquid assets, right? And they are cash. and cash equivalents. Stocks and bonds. And you understand these stocks and bonds are not the company's own stocks and bonds, but the company's holding of other stocks and bonds of other companies, right? In other words, this is part of the company's money management, right? And then accounts receivable. And I will just accounts receivable. It's hard to write. Accounts receivable. Promissory notes. And inventory. Finally, inventory. And then liability side, of course, there's current liabilities, which is short-term liabilities, and there are line items. And then long-term liabilities or long-term debt. I used current liability, then, oops, I better use, non-current liabilities. Which are mainly, bonds and, mortgage. We'll just stop there. And equity. And the capital, that was, so if total capital raised, through equity and debt is 10 million, right? And let's say equity, out of that, equity is 6 million. That means what? If equity is 6 million, what is the current liabilities? What is the sum of current liabilities and non-current liabilities?
4 million.
Yeah, it will have to be 4 million. It's obvious, right?
Right.
It will have to be. And who said 4 million?
That's me, Professor Damien.
Damien, okay, Damien, I'll give you 0.25. I mean, this is a very easy question, but at least someone's paying attention, right?
Indeed.
I will give you 0.25. It's September 23rd. Finance 300. Damien, you got 0.25. And think about it. Out of this 4 million, maybe we can break it down further. Okay, out of this 4 million, maybe bonds and the long-term debt, it could be 3 million, and that means current liabilities are 1 million, right? So they add up to 10 million, right? And so asset side will have to add up to 10 million as well. Asset side will have to add up to 10 million. And let's say if you are a plant and equipment, land and building means you are a manufacturer. If you're not a manufacturer, right? If you're a retailer, you wouldn't have any plant and equipment. Isn't that right? Retailer doesn't have any plant and equipment. So it's the manufacturer, clearly, manufacturer. And the manufacturers, so the non-current assets, if all of this is 9 million, let's say 8 million. If plant and equipment is 8 million, and the rest of current assets will have to be then 2 million, right? That's obvious. But what can you also tell? What you can tell is, this plant and equipment and land and building was acquired by long-term capital. Non-current assets, in other words, non-current assets and equity are called long-term capital. This is short-term capital only, right? That must have been acquired by, through, it could be any combination. It could be any combination, but this 8 million must have come from, it could have most likely come from this 9 million, right? Out of this 9 million, 8 million turned into plant and equipment, land and building, right? Makes sense? Of course, mortgage would be clearly, what will be a mortgage will be what is, what financed the building and land, right? And then, equity and, bonds were used, to pay for the, plant and equipment. So as we look at the balance sheet, we can tell something about the balance sheet. Of the $10 million, 60% is equity, right? 40% is debt, right? That's called capital structure, right? And then this 6 million equity was raised by selling. Was someone saying something? This equity of 6 million, this is the book value. I think. I better. Yeah. This is the book value, right? Of course, we can have we have book value for plant and equipment and land and building, right? And depreciation, accumulated depreciation will reduce the book value. But that's the that's the book value for your assets, right? But then, when we say book value, right? And because we are in equity context, this is the book value of the equity. Okay, this is the book value of the equity. And how did we raise 6 million? We raised the 6 million by, let's say, selling uh, uh, 1 million shares. Uh, by selling 1 million shares times $6 per share. Okay, so what does this mean? Um, if this company is prior to going public, if this company is prior to going public, then this is the share price that they sold it to the initial investors, the original investors, right? Now think about it. um, every startup, basically, they have hard time starting up the business because they don't have capital, right? So theoretically, what would you have to do? You will have to go to the bank and get a loan. But then uh, no bank will lend to a company that has no track record. No bank will lend to a startup, right? Uh, a startup is nothing but an idea. It's a big question mark, and no bank will lend like and if the startup capital required is like $10 million or $100 million, no bank will lend. You might say, oh, isn't there like SBA loan? Yeah, if it is a small business, and of course, small business, you have to meet all these requirements. I don't know how difficult it is to get a small SBA loan, but even SBA loan won't be that easy to get. And you will need to have uh, sufficient collateral. I mean, a small business loan would not require that much collateral because it is specialized for, it's a special loan for small business. If it isn't requiring that much collateral, then the interest would be high or whatever. But as I said, theoretically, you must get a loan from the bank, but nobody lends to a startup, uh, and you cannot sell stocks. Think about it. You don't, to sell stocks in the stock market, you must be listed in the stock market. But you're just a startup. There's no, you cannot get listed in the stock exchange. So, and even if you can sell stocks in the market, you are just a startup. Nobody knows, nobody is going to buy your stock because it's completely a unknown company with no track record. So then, how can anyone start a startup? Uh, so, huh?
They do crowdfunding.
Ah, well, look, that's a very optimistic. Yeah, you can, but how many? I mean, crowdfunding is really, if you're lucky, and think about it. I would say that's a kind of naive idea, naive optimism, because crowdfunding is simply uh, uh, if you do crowdfunding, I mean, if it is let's say I have cancer, but I don't have any I don't have any insurance. I'm very poor. I don't. I mean, it's almost like a charity. I mean, if people give money to crowdfunding, they don't expect any return from it, right? Isn't that right? Of course, there are crowdfundings that are on a different level. They may say, I have this idea, and I want to launch this product. I don't have capital. I will give you, 10%. I will pay you, 10% over your initial investment, and if you
Angel investors.
yeah, that's the so
I hope I get
crowdfunding.
some points, Professor, for today's class. A lot of participation going on.
Yeah. Who was that?
Anthony Neuer. Anthony Neuer.
Anthony. Okay, Anthony.
Thank you.
Yeah, angel investor, or that's an expression, but that's venture capital. In other words, it's venture capital. Venture capital. You'll have to go to the venture capital because crowdfunding, you can't really rely on that, right? You can't really rely on that. It's not really, and there's clearly a limit. I mean, if you require 10 million, think about this business. I mean, this business requires 10 million. And how likely are you to raise 10 million through crowdfunding, right? And maybe you can do crowdfunding like, issuing stocks. If you donate me, if you fund me, I will issue one share for every $5. So, I mean, that can be possible. But then crowdfunding is not a very reliable reliable method for raising like $10 million or $50 million, $100 million. You would have to be very, very lucky to reach that goal. But so you got to look for a venture capital. Venture capital are basically specializing in specializing in taking risk. I mean, a startup is a huge risk. Think about it. A startup is a huge risk. So they will, but if they think your idea has a merit, they will invest, and then they will invest, let's say $6 million, right? And that's like then they will have 1 million shares if you. So this is just artificially, arbitrarily set, right? $6 per share is an arbitrary price because it's not market price. It's just price that you arbitrarily assigned to, and then when you go public, right? When you go public, then IPO price. If the IPO price is $60, if IPO price is $60, and then you issue 10 million shares. So at IPO, let's say at IPO, you issue 10 million shares at $60 per share, right? That's $600 million, right? And that's the book value at IPO, right? And this is IPO price, right? IPO price, and that's the paid-in capital, right? It's also called paid-in capital because it's literally paid in. Of course, this is also paid in capital too, right? Because the venture capital paid in. So then, venture capital will most likely bail out at this time. In other words, they, tenfolded, right? They tenfolded their initial investment. If they have, 1 million shares, right? They paid originally $6 per share, and now IPO price is, $60. So that's going to be, 60 million now. I mean, 60 million, right? They tenfolded their investment, and they usually, sell off, and then, they bail out. But they can still remain. If they still remain, your total equity will be $660 million, right? The total equity will be that's the book value of your equity. And then as the trading happens, as the trading goes on from the secondary market, as the trading happens, there will be price will fluctuate. If the price goes up, good. If the price goes up from $60 to $100, then that's the market capitalization. I mean, you have if the venture capital has already sold and bailed out, then you will have 10 million shares at market price of $100, right? And in I have to reposition myself in secondary market. So after IPO, 1 year has passed, 2 years have passed, whatever, 1 month has passed, 2 months have passed, there has been trading going on, and there will be, if they haven't, if venture capital will most likely have, bailed out by now. So you have, 10 million shares outstanding. And then each share is selling for $100, right? Now, this is called market capitalization. I mean, then, but that's not book value. Book value is, think about it. When at IPO, the company sold the stock to the public for the first time, and it was at $60 per share. So what the capital that transferred from the public to the company, right, was only $600 million, right? That makes sense. $600 million. That is the book value. But after that, stocks are basically trading between investors, right? Between one investor and another, right? So that's called the secondary market, right? Whereas, at IPO, that's primary market. That's primary market because in the primary market, basically the capital flows from the public to the company, and that's it. And the capital that moved, that was paid into the company was 600 million, right? That's 600 million. That's the book value. This is so hard. Let's see. And that's book value, right? Book value of your equity, right? And then uh, in the secondary market, if the price went up to $100, then 10 million times 100, that will be that's not the paid-in capital. It will be what, $1 billion then, isn't that right? 1 billion. But that's called, market value, right? That's the market value. This 1 billion is called market capitalization, right? So when we say, book value, we need to understand it in the equity context, right? Of course, in accounting, book value. In accounting, they also call this book value, but no, the focus of accounting is mostly about the book value of the asset, book value of the physical asset, right? Physical asset like plant and equipment, and then how that book value depreciates over time. So what is, so everyone is clear about that, everyone, right? And if this is something that happened, at the end of the first year, I mean, in the secondary market, and at time at time t1, 1 year later, right? And this is time t0, right? At IPO, that means, time t0. This is the first time, they went public.
Professor.
Yeah, go on.
So
go ahead.
The difference, the 400 million, so that's the capital gains for the investors, right?
Yeah, that's the capital gains for the investors, for the shareholders, not for the company, right? Because
Yes.
company got the paid-in capital of 600 million, right? And the investors are holding 10 million shares, right? Of course, if the company, if company can repurchase the stocks, but let's say it's been only 1 year. Company sold 10 million shares, and 10 million shares are all held by the investors. So investors in total, they gained, you're right, the investor, but this is to the shareholders. 400 million capital gain is to the shareholders, right? Of course, think about it. You are, if you have already sold it, you don't. I mean, if you're holding it for 1 year, if you have held it for 1 year, you realize, this is like from 6 of 4 over 6 is 2 over 3, so that's 60%. 2 over 3 is like 67%, right? So you will have gained 67% return. You will have realized 67% return if you bought it at IPO at time 0, and if you held it until time 1, right? You would have realized 67% return. If you have already sold it prior to that, then no, whatever. But if you're one of the original shareholders that bought at IPO, and 1 year later, you would have realized 67% gain, 67% return, and the capital gain is to the shareholders, right? And shareholders are not only now, the original venture capital, if venture capital has left, right? They sold and they left. They at IPO they already made 1,000% return, so they left. And so you are the owner of the company. I mean, this is you're not the only one, but all the shareholders are the owners of the company. But you are the original founder, and as the original founder, you must have given yourself some stock option, right? when you issued let's say 1 million shares, right, to the venture capital, you could have also issued yourself 1 million shares, right? But this 1 million shares, because you are the you are the founder, right? Without any paid-in capital, without paying in any capital, you can simply issue yourself, So then originally, if there was 2 million and 1 million, the venture capital sold 1 million and 1 million shares, and they bailed out. And then at IPO, there was, you issued 10 million. And so including that 1 million you had, then it will be 11 million shares, right? And 11, then, the calculation will be 11 million shares times 100. So the market capitalization will be 1.1 billion, 1.1 billion, right? And you will be one of the, because you are the you are the founder, you are the original founder, and you had 1 million. Now you realized also 67% return. I mean, actually, you didn't pay in anything. You didn't pay in anything. Your return is you didn't pay in anything. So your return is almost infinite. Because think about it. You paid $0, right? So you cannot divide. Now the price is $100. 100 divided by 0. 100 minus 0 divided by 0. Of course, you cannot divide anything by 0. I mean, it's undefined. But let's assume instead of 0, let's say it's like 0.000000001, almost close to 0. I mean, just to make it mathematically possible. Say your paid-in capital was 0.000000001, right? And think about it. 100 minus 0.0000001 divided by 0.0001. This calculation is possible. I mean, it's not undefined. This is infinite. Your return is infinite. Isn't that right? Your return is infinity. You understand? You paid in terms of financial capital. Huh? What did you say?
I said I was listening. Yeah.
Yeah. Please enunciate when you say something because the microphone gets plays a trick. Yeah. In other words, of course, you are the founding member, so you instead of financial capital, you invested your intellectual capital into it, right? Isn't that right? For that alone, I mean, you designed everything. You had this technology. You designed everything. So basically, you didn't have to put in any financial capital, but maybe it already justifies 1 million shares stock option to yourself. But the point is, this is mathematically the return is infinity because no financial capital went in there from you, right? But whatever, even $100 or whatever, you will even $60 or whatever, divide any number by close to 0, right? 0.0001. That's infinity, right? Does that make sense? So that's what I mean by book value, right? As opposed to the market value. Okay. Where was I? Okay. And although the book is just giving you the very fundamental, basic definition of book value, which is mainly used for fixed assets. Okay. Of course, your equity should also reflect. I mean, think about it. If your company's total assets come 100% entirely from equity, right? Your company's asset comes entirely from equity. Apple was a good example of a 100% equity financed company until 2012. Until 2012, Apple had no liabilities, no debt in their balance sheet. But in 2012, they started to sell bonds. Okay, so that's the debt. But then why did they do that? Did they need it? They didn't need it. They didn't need to borrow money. But why did they do that? Because that was, that was the time when we are still, we're still in the lasting the post financial crisis era, 2008 and after, right? And what is the typical characteristic? What is a very typical characteristic of post financial crisis era? 0% Fed funds rate, right? Fed funds rate is 0%. So all interest rates are very low. You all understand, you put money, in the bank, you don't even get 0.1% on savings account, right? So that means also the borrowing rate is also low. I mean, to be more specific, borrowing rate is the interest rate that you get when you put your money in the bank. Well, you might wonder, and this is Finance 100 material, because I already explained everything in Finance 100.
Professor.
Yeah.
So Apple went public and then used that money to basically to go into like the market and like multiply that money. Like that they
No. Look, what do you mean by Apple going public? Apple went public in 1981. Apple went public in 1981, and going public means selling stocks. Okay, Apple sold stock for the first time in 1981, and at the time it was like $10. And we did the calculation. I believe Apple and there has been stock splits, a lot of stock splits, over the years. So
so what did they do in 2012?
Huh? What?
What was it that they did in 2012 then?
Oh, 2012. I said they sold bonds. They sold bonds, right?
Okay, yeah.
Not stock. In 2012, I told you, look, the funding comes, the capital comes either from debt or equity, right? Most of the time, the combination of the two, right? Bond is debt. But prior to 2012, Apple was 100% equity financed. So look, if Apple's total assets was $10 million, all of that $10 million was all equity, right? All of the $10 million was all equity. So they didn't have to sell bonds, right? Because bond is borrowing money. They didn't have to do that. But they sold bonds in 2020 for the first time. Why? So that's what I was explaining to you. Post 2008, post financial crisis era, the most typical characteristic is the low interest rate, right? Low interest rate. And low interest rate means, not only when you put your money in the bank, you get, a very low derogatory interest rate like 0.1%. But when you borrow, it's also low rate. and if you are if you have excellent credit score, like above 820, when you borrow money, you'll get probably about 3.25%. I mean, your interest on if you get a loan, your interest will be at like 3.25. That's called prime rate, and that's and Apple is like a AAA company, so very high credit rating. Um, uh, and as an individual, if you get 3.25%, that's the lowest possible rate. That's the prime rate, because usually the prime rate is about 3% above Fed funds rate, and with Fed funds rate being between 0 and 0.25. This has been the case since 2008, right? And it started to crawl up a little, around 2018. But as with the pandemic, the shock to the economy, due to this shock to the economy, at the early onset of the pandemic, the economy was slightly about to go into recession, but it was prevented because of quantitative easing, massive asset purchase and easy money policy, so that with low interest rate is the part of that, so you can borrow at low interest rate. And the stock market has been generally booming all these years, since 2010. I mean, in 2010, the economy bottomed out. Actually, we bottomed out of recession in 2010. It took very long time. It took almost the entire, decade for the economy to expand. But the recovery started in like 2010. So all those during the Obama administration, 2 terms, it was the economic recovery period of prolonged economic recovery. But anyway, Apple sold bonds in 2012 for the first time, although they didn't need to. The only reason was it was cheap to borrow money. Apple being like AAA rated company, they could probably sell bonds. I mean, if you borrow from the bank, 3.25 is the prime rate. But if you sell bonds, if in the bond market, you can borrow money probably at much lower rate. Probably 1 point something, 1.25, or for a company like Apple, which is AAA rated, right? They could most likely sell bonds for 1.25% interest, at 1.25% interest rate. Suppose Apple sold, $100 million or $1 billion in bond, right? They sold bonds for $1 billion. That's borrowing money, $1 billion at 1.25% interest rate. But just for 1 year, let's say just for 1 year, they don't even needed it. They didn't even need it. Well, they borrowed. Why? Because the stock market was so good. If you put that 1 billion in the stock market, you could get at least, on average, 10% return. Let's say if you can get 10% return on average, why wouldn't you? You borrow at 1.25%, put it into stock market, and on average you get, expect a return of, 10%. Then even after paying back the bondholders, the principal of 10 billion, 1 billion, and the 1.25% interest, Apple nets out. Apple, ends up with 8.75% return, right? So that was the only reason. That was the sole reason they sold bonds. Apple didn't have to borrow money, but they borrowed money at a very cheap rate because they, they did them basically money management, right? It's just simply a very, very simple form of financial engineering. Borrow at a cheap cost and get higher return, pay back, and you're still, not using your own money, right? You could get, you could end up with. So now we're out of time. So I was, just, touching on the book value, and then, the rest of them, it's just the just a basic foundational concepts. I mean, this is, not something to get, bogged down with. We have like valuation models, or we will start with the valuation models, in the next class. But these are already, valuation models are something we've done already in Finance 100. But I hope you have, understood, got the clear understanding of the distinction between the book value that they, in the context of, depreciation of fixed assets, and distinction between that and the book value of the equity, and the distinction between book value of equity versus the market value of equity. Okay, all righty. So that's it for today. Any? I have what? I'm down to 6 people. This is a disaster. What happened? Originally, I had how many people?
I don't know, but I found the discussion very interesting today, especially the Apple part.
Yeah. I'm glad to hear that. And at least someone's someone's interest is rekindled. That's very. There were 17 people originally, and then down to 7. I lost 10. What happened to these people? I think there should be some penalty for. I think there should be penalty for. But as I said, a collaborate session is more like a reflection, right? Reflection, not really a main lecture. So if you need this time for the main lecture, I can't blame you, right? If this is the only time you can watch the main lecture videos, I can't blame you. But I hope you have, I hope you have enjoyed and learned something from this collaborate session. Okay. So I'll see you guys on next Thursday, and I believe there is a chapter problem on Connect. So please, don't forget to do that. So that's it for today. Any more questions? Even if you have any more questions, I'm already beyond the assigned the time. So any further questions? You can use my office hour. Okay. Anthony Neuer, actually, you had a. All right. Have a good evening, Anthony Neuer. You had an appointment, my office hour appointment today. Right? Nobody's here now. I mean, you didn't show up, Anthony. All righty. So I'll see you guys next Thursday. Have a good evening and take care. All right. Stop. I'm signing out. Stop sharing.